So why don't we get started, and people who join us can join midstream. So first, hi everybody. Thanks so much for joining us today. I'm Dennis Kelleher. I am the President and CEO of Better Markets. And this is the second anniversary of the failure and bailout of Silicon Valley Bank and the onset of the 2023 banking crisis. Coming 15 years after the 2008 crash, that crisis was the first real stress test of the post-Dodd-Frank financial reform architecture. Unfortunately, the reflex proved to be bailouts without transparency or accountability, notwithstanding years of working on resolution authority, living wills, and so much more. I wanted to remind you of just a couple of quick facts about 2023. 3 of the 4 largest bank failures in history happened in 2023. The direct bailout cost for those banks were greater than $40 billion, and the all-in cost due to credit contraction and related issues will exceed $300 billion. Highly consequential, needless to say. However, today isn't just about 2023. It's also about today, tomorrow, and the years to come. For example, as the Trump administration unleashes massive, widespread deregulation across banking and finance, it's important to remember that the 2023 banking crisis was a direct result of deregulation during Trump's first administration from 2017 to 2020. There's always a lag between deregulation and financial crashes. And that's not just in 2023. 2008 was also a direct result of deregulation in the 1990s and the early 2000s. And let me just add a reminder of a couple of key facts from then. It took 10 years after the 2008 crash for the U6 unemployment rate to return to 2007 levels. There were 16 million foreclosure filings in the United States. By the end of 2016, 8 years after the crash, 90% of Americans were poorer by 17 to 35%, according to a Federal Reserve study. So yes, we're going to look back to 2023, but we're also going to look at where we are in banking regulation, banking and finance today, and where we are going. These are perilous times, and they are laying the groundwork for an uncertain future. Sledgehammers are being blindly and callously applied to people, institutions, regulations, and the rule of law. Now, thankfully, as we look back to 2023 and forward to what's to come, we're really lucky to have 3 experts with us today to talk about these issues and so much more. First, our fantastic banking director, Shana Olesic, who has decades of experience in banking regulation. She's the author of a mountain of materials that you can find on our website, www.bettermarkets.org, including the report released today, which I'm going to hold up and show you, on the 2023 crisis itself and how Main Street is still in danger. Second, our panelists that we're so lucky to have are KATHRYN Judge, a professor of law at Columbia Law School, and Jeremy KRESS, a professor of law at Michigan Law School. I could talk for a long time about their accolades, accomplishments, and expertise, but you can find all that in their bios, which are linked on the website announcement, on the webinar announcement on our website. But let me summarize. These are 2 of the nation's leading thinkers and scholars about and experts on systemic risk, financial stability, banking, bank regulation, bank regulatory agencies, banking and financial crises, and policy making in Washington, broadly speaking. If you want to know what's going on, you really have to read what Kate and Jeremy are saying, what they're writing, and where they're talking about these issues on the various platforms. So with that, let me hand it off to our terrific panel for what I'm sure will be an engaging discussion. Off to you, Shana.
Thank you, Dennis. And welcome to everyone. Thank you for joining us today. It's really exciting to have so many people who care as much as we do about the banking system and ensuring that it works for all Americans. That's really the purpose and goal of our conversation today. As Dennis said, this is not going to be a history lesson or an economics class, as much as I loved economics class. Instead, we'll be taking a common sense look at our banking system that we all depend on to protect our money. We'll be talking about what went wrong to cause the 2023 banking crisis in the first place. Didn't we learn from the prior crises and ways to protect our banking system and Main Street Americans' hard-earned savings? Then we'll talk about the developments in the last couple of years since the crisis, and really why those changes, while some have been positive, they have been relatively small, all things considered. And most importantly, we'll be talking about what still needs to change to make our banking system safer and make it work better for all of us. So, of course, we also have a new administration in place, and we'll be considering how that may affect the path forward as well. So hopefully many of you have visited the Better Markets website, where you can find a range of information about various topics that matter to all of us. And most relevant to today's discussion is the report that Dennis shared, which if it hasn't been put in the chat, a link to it will be put in the chat so you can easily find it. So we also have several questions that were gathered ahead of today's webinar, but we definitely want to hear from you today. So please write in your questions to the chat. We'll be addressing those later in the conversation. So first, let's start with some background information to set the stage. So thinking back to the spring of 2023, the pandemic was easing and it felt like things might be getting back to normal. We could not have been more wrong. We were hit with the rapid succession of the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. As Dennis said, these were 3 of the 4 largest bank failures in US history, and a stark reminder of the vulnerability that exists in our banking system. Now, there was a 4th bank, Silvergate Bank, that also closed during this time period. This bank is often left off the list because its closure was voluntary, but it also suffered an enormous run just a few months earlier because it could no longer operate safely. So there's many commonalities among these failures, concentrations in risky business lines, including crypto, dangerously bad banking practices, egregious conduct by the bank executives and directors, and multiple shocking failures by regulators, supervisors, and policymakers. And unfortunately, few of these causes have been meaningfully addressed. And then there's the enormous price tag, $40 billion in direct costs and much more in terms of contagion and lost GDP. So that's what I remember from the spring of 2023. Kate and Jeremy, what sticks out in your memories from that time?
You summed it up well. I'll add the extent to which this was entirely predictable when one looks closely at what was going on with these banks. And yet what we see is a complete lack of preparation for it. Interest rate risk is the most classic banking risk that exists. We had the Fed increasing interest rate risks, or increasing interest rates in ways that really created the possibility of interest rate risk becoming manifest, duration risk becoming manifest on banks. Every banker should have been paying attention to this. Every regulator, every supervisor should have been paying attention to this. And we're also dealing with a handful of banks that had a number of indicia that are classic for failed bank institutions. They were growing rapidly. Growing rapidly is sometimes a good sign, but very often it's a sign of a business model you need to look at more closely. They were growing in ways that had business models that involve specific risks in crypto, high concentrations in particular areas, whether it's wealthy clients or VC, but high degrees of concentration, which again entails greater degrees of risk. And they were losing deposits. for a lot of these banks, we saw significant increases in their use of things like Federal Home Loan Bank advances to maintain liquidity because they were actively losing deposits. So if there's ever a situation where bank management, supervisors and regulators ought to be able to respond in a more timely way and in a way that allows an orderly resolution without a significant government backstop, it seems like this should have been it. And yet that could have been farther from what actually happened.
Yeah. For my part, what sticks out most when I think back to 2 years ago was how quickly and vividly the 2023 banking crisis disproved the entire premise on which the Trump era deregulation from 2017 to 2020 was based. If you recall, the project was known as tailoring, and this was the process through which the banking agencies and Congress deregulated banks, primarily, although not exclusively, banks between $100 billion and $250 billion of assets, large regional banks, essentially. And the premise was that these banks were not systemically important, could not be systemically important, and needed deregulation in order to better compete with the mega banks like JP Morgan. I always think, when I think about the banking crisis, I think back to January of 23, when Randy Quarles, who was Trump's former vice chair for supervision, appeared at a symposium organized by the OCC. And he said at that symposium that large regional banks would need a significant increase in their size and complexity before they could pose a threat to US financial stability. And that was the ethos that underlied the whole deregulatory project. January of 2023, he says this. 2 months later, of course, SVB and Signature fail. Policymakers invoke the systemic risk exception precisely because the failure of those banks posed a threat to US financial stability. We often talk about the 2023 banking crisis through the lens of SVB because it was the first and biggest of the failures. But this was really a crisis of an entire category of large regional banks. In March of 23, we had 14 banks or bank holding companies with between $100 billion and $250 billion in assets. That March, 3 of them, SVB, Signature, and First Republic, failed. Later in the year, a fourth, New York Community Bank, which we haven't mentioned yet, required a sweetheart deal rescue by former Treasury Secretary Steve Mnuchin. And who knows how many more of those 14 banks would have failed but for the invocation of the systemic risk exception and the bank term funding program that operated as a government backstop. So when I think back on the crisis, what sticks out to me is the tragic irony that we deregulated banks like First Republic so that they could better compete with banks like JP Morgan. And guess what? Today, because of the crisis, First Republic is now part of JP Morgan.
Yeah, thank you both. It's amazing how much we can easily think back to everything that we were thinking about during that time. So let's keep talking about some of the important causes of the crisis. One thing that sticks out in my mind is so we have this system of regulation and supervision. So there's the rules that are set up to protect us all, and then there's supervision. These are the bank examiners and regulatory staff that are going into the banks and making sure that they're following the rules. And when we look at the reports that came from the bank regulators, as well as the Government Accountability Office, the GAO, it really paints a very clear picture that there were some severe failures both in the regulation, but also the supervision. One of the most important structures and cultures at the regulatory agencies is these examiners who are very skilled, very smart, and very dedicated to their jobs of protecting the banks and making sure that they're operating safely and fairly. But the deregulatory actions that were loosening the reins on the largest banks were also coming at the same time that we saw this shift in expectations and practices and culture at the regulatory agencies. So the Fed's report spells this out pretty clearly. It says that staff approached supervisory messages, particularly supervisory findings and enforcement actions, so trying to rein in these risky practices. So staff was noticing what was happening, but they were met with resistance and a need to continually accumulate more and more evidence to prove their points. So this really resulted in delays and in many cases not taking action. The Government Accountability Office report, the GAO report, also spelled this out, saying that years before the actual failures, there were signs that these banks were not doing well. As early as 2019, the regulators were identifying risky practices at the banks, including many that you both have talked about. So, I just worry that that these structures and cultures are preventing examiners from doing their jobs, and the fact that their judgment is being questioned. So, Jeremy, let's hear about some other causes that you see. What can you share with us?
Yeah, so let's first stipulate that primary cause was terrible management, right? That's table stakes. These managers did not understand interest rate risk and didn't manage those risks appropriately. So that's first point. Shana, you addressed failures in supervision. I want to focus on failures in regulation, continue on the theme that I addressed initially, specifically focusing on inadequate capital and liquidity. You talked about this in the great report that you published earlier this week. Poor capital and liquidity regulation allowed these banks, these large regional banks, to shift the costs of their risk-taking to the FDIC and to other public sector backstops, rather than forcing the banks to internalize the costs of their own risk-taking. Absent tailoring, SVB would have had to maintain $2 billion more in capital in order to keep the same regulatory capital ratios. Absent tailoring, SVB would have had to have an additional $14 billion in high quality liquid assets in order to meet their minimum liquidity requirements. But because of tailoring, SVB was able to distribute that capital to shareholders. It was able to hold less liquid assets, and that had the effect of shifting costs to FDIC, other banks, and taxpayers. I'm not sure that additional capital, that additional liquidity would have prevented SVB's failure, right? SVB experienced an extraordinary run, $100 billion in outflows over 2 days. Not clear that any amount of capital liquidity could have prevented that. But what it would have done is it would have shifted the costs, forced SVB to internalize them. That $2 billion in capital that SVB didn't have to have because of tailoring is a straight up value transfer from the deposit insurance fund to SVB shareholders. And that's, it was foreseeable going in, and it's one of the biggest causes in my mind of how we got where we are.
Thanks, Jeremy. Kate, what do you have to add about the causes of the crisis?
You've both laid out a lot, but I do think it's worth diving into Jeremy's first point, which is whenever a bank fails, the first place you want to look at a bank management. This is a failed business model, particularly when it fails in a messy way. Again, there's ways that a bank can fail where there's not knock-on effects and there's not the need for massive government intervention. The failures that occurred in 2023 were massive failures because of the problem. Silvergate, again, I agree with you, Shana. Some people belittle how important it was to this overall episode because it didn't actually involve the invocation of the systemic risk exception. But of course, that's what triggered the other failures. That came 2 days before the failure of SVB, and then 2 days after that was a failure of Signature. So whenever you have significant knock-on effects, it's a sign of regulatory failure. When First Republic gets bought by JP Morgan, it's a sign of a regulatory failure. So against that backdrop, the question is, what more can we do? One is enhancing supervision. Another is enhancing regulation and making supervisors feel more powerful, making sure the regulatory scheme suits. Another is actually just implementing the regulations that Dodd-Frank requires us to put into place, particularly when it comes to bank executives. There's other legislation that has been on the table that I think would also potentially be quite helpful. But a core challenge that we saw in 2008, and it played itself out again in 2023, is there's an asymmetry between the risk incentives, oftentimes of management shareholders, relative to what's actually socially optimal. And that arises precisely because the government ends up stepping in and absorbing a significant portion of the losses, oftentimes associated with bank failures. And so the core challenge has been, how do we start to address this inherent asymmetry that exists that time and time again has resulted in banks taking excessive risks? A core component of how Dodd-Frank tried to address this was through Section 956 that says, look, we need to actually make sure that bank executives are not being compensated in a way that exacerbate this mismatch, that actually rewards them in situations when they are taking risks that, if they happen to go well, will pay off for bank shareholders, and if they go poorly, will really be unhealthy for the resilience of the overall financial system. We saw a proposal go out in 2011. We saw another one go out in 2016. We saw it go out again in 2024. It is now 15 years almost since the passage of Dodd-Frank, and we haven't even managed to finalize that regulation. And again, this wasn't something that was optional. It's something that Congress said, we think this is a problem and this needs to get done. So I think there is also this fundamental question of what it is in this overall ecosystem that's preventing common sense regulation already mandated by Congress from actually being implemented in a healthy and appropriate way.
Thanks, Kate. And I think, one thing that you mentioned, these rules were part of Dodd-Frank. So we are now over a decade overdue with things that policymakers knew were necessary to really protect Main Street Americans and not allow the bank executives to benefit from the excessive risks they were taking. And it's really unfortunate that we've just allowed this to go on for as long as we have.
If I could, I completely agree with Kate on 956. I would add to that list the early remediation rules required under Section 166 that, had they been in place, might have detected some of the vulnerabilities in these large regional banks. Unlike 956, the early remediation rules are just a Federal Reserve requirement. So there is no, 956 is an interagency rule that may help explain why it's been delayed. The Fed has the ability and indeed the requirement to adopt those early remediation rules. It has chosen not to do so. We are now well after the statutory deadline. Contrast that with the tailoring rules from 2018 that the Fed rushed to finish in time to meet the statutory deadline. So it's mismatch on what the Fed chooses to implement and what it decides it can ignore.
Thank you both. So let's turn to developments in the last year. As we said at the beginning, there has been some things done over the last 2 years, and particularly in the last year. So Kate, what can you tell us about your observations of what's happened in the last year and how effective it's been?
Yeah, there's a lot. So one positive sign and one fairly disturbing sign. On the more positive side, we did see that the FDIC, in its role as a receiver, so it comes in and is the receiver once you have a failed banking organization, has sued 6 executives and 11 former directors of SVB. And again, because part of what we really need to have happen is to make it so the bank management and bank directors who are in the best position to determine what the business plan should be to understand the risks and to manage those risks appropriately, internalize at least some of the costs associated with the decisions that they are making, making sure that there is appropriate liability when existing law actually already provides for it is key. So we'll see whether or not that suit goes forward now that we've had a change in administration, and it's certainly something to watch out for. But I think at least the filing of the suit is a really positive step in the right direction. It's signaling that we actually want to make sure that bank directors, bank management know that they have fiduciary duties. When they're breaching those fiduciary duties in ways that cause significant losses, there's a possibility that they are actually going to be held liable for those decisions. The more troubling sign is, I think, since we've seen the change in administration, we've actually seen, I think, indicia that we are going to go right back to where we were, if not to a much more troubling place than where we were in terms of having adequate supervisory staff, capable supervisory staff, and supervisory staff that actually feels empowered to really ask very difficult questions. And again, the way the overall bank regulatory system works is we want bank regulation to be the first line of defense. We want capital requirements, liquidity requirements. We want appropriate resolution planning to all be in place. And those are absolutely critical. But because of the incentive problems that exist, very often you actually do need supervisors to go in and figure out, well, where are banks taking risks and assuming risks that actually might become manifest in troubling ways that are not adequately accounted for in the current system. And so we need to have supervisors on the ground really asking the hard questions and then feeling empowered to push back when they see trouble. The report that you described earlier revealed that there were significant problems in terms of the culture, but also in terms of the staffing. And yet we're seeing right now, again, efforts to actually cut back on the size of the staff, even when doing so could be incredibly costly for the country and really potentially undermine resilience. So I think it's one of the many troubling signs that I see on the current horizon.
I agree, Kate. And it's not just cutting staff that could help now or could help in the near future, but by the cuts that we're seeing at the agencies, you know, this is cutting staff who would be training to help us for years to come. And so, you know, I worry that this is a much longer term problem that that we'll really regret. Jeremy, what have you seen in the last couple of years that seems promising?
Yeah, so I'll talk a little bit about an area where I've been researching, and that's how we resolve banks after they fail. Yeah, I was troubled that the solution to the bank failures in 23 was just merging them with bigger banks. You know, at the time of the crisis, I was on detail to the Department of Justice. I was advising Assistant Attorney General Jonathan Cantor on bank merger policy. And, you know, after the banks failed, they went into resolution. The FDIC sought merger partners. Ordinarily, when banks merge, the DOJ has a say on whether those mergers would lessen competition, and the DOJ can block a merger that would substantially lessen competition. Not so when banks fail. Those failed bank mergers are exempt from antitrust review. When the FDIC resolves a failed bank, it typically puts the bank up for auction. By law, the FDIC has to resolve that bank in a way that incurs the least cost to the deposit insurance fund. That least cost requirement typically means selling the bank to the best bidder. So that's how we ended up with First Republic being sold to JP Morgan. 4 banks bid on First Republic. JP Morgan, according to the FDIC, submitted the best bid that would minimize costs to the deposit insurance fund. Reportedly, although these figures are not public, but according to reports, JP Morgan outbid PNC by about $1 billion for First Republic. So by law, the FDIC had to sell First Republic to JP Morgan. That didn't sit right with me. I think that the world would be better off today if PNC had acquired First Republic instead of JP Morgan. Not that I think that PNC should be getting bigger through mergers, but as between the two, I think that PNC was the preferable acquirer there. So in the past year, I've been working on a project that I call least cost resolution, least cost in parentheses, because I've concluded that we should get rid of this least cost requirement. The cost to the deposit insurance fund are certainly one societal cost that bank resolutions impose, but they are far from the only costs. When merging failed banks, there are costs related to losses in competition, costs related to future financial stability risks, costs related to financial exclusion. Today, the FDIC is prohibited by law from taking into account those other costs. It has to look only at costs to the deposit insurance fund. So in this paper, I draw some proposals for eliminating or substantially modifying the least cost requirement, giving the FDIC more latitude to take into account those other societal costs when resolving failed banks. And I'm pleased that there has been some momentum behind this idea on Capitol Hill. Senator Elizabeth Warren, now the ranking member on Senate Banking, has spoken positively about modifying the least cost test. Now Vice President J.D. Vance, when he was on Senate Banking, endorsed this idea of giving the FDIC a little bit more latitude. So I'm hopeful that we might see some changes going forward so that the next time we have this rash of bank failures, we're not going to end up with selling the failed banks just to the highest bidder, who might once again be JP Morgan.
Thanks very much for all your work on that, Jeremy. And I think we have the link to your work as well, which we can put in the chat for anyone who's interested. I would also add, in the last year, there has been some important changes to the process and the rules around banks planning for their own potential failure. These are called a lot of different names, resolution plans, but the term that I like to think of as living wills or recovery plans. These are plans to for the banks themselves to put together a roadmap for how to not endanger the banking system, the financial system, Main Street America, and really worsen the too big to fail problem by the need for another bailout. So the banking agencies proposed several changes to strengthen their planning process. The plans or the new rules were proposed in 2023 and were finalized last year in 2024. And I think that there was some positive steps taken in those planning rules, but they didn't solve all the problems. And one thing that really stood out to me is the fact that now there's a 3-year gap between the time that the cadence that banks need to, the largest banks need to file these plans. So, as we saw in 2023, things can change very quickly, and a bank that we thought was stable and sound, the condition can change very quickly. So it's really troubling that there's now this 3-year lag between the filing of these plans. Now, there is some interim data filings that are part of the process, but I just don't think that's sufficient. And former FDIC Chairman Gruenberg even pointed out last year in a couple speeches that the elephant in the room is that the regulators have not proven their ability to manage a mega bank failure without a bailout. This has never been done. So we can have the best plans in the world, but there's still this question about whether it can actually be done successfully and not also be accompanied by some sort of bailout.
Can I jump in on that quickly, just because it is such a fundamental point? I think this conversation has rightfully and understandably focused on what we've deemed to be the regional banking crisis in the United States and the realization that regional banks are systemically significant. But let's not forget that if we actually go back to spring 2023, one of the most cataclysmic failures, or potentially cataclysmic failure, was the failure of Credit Suisse. Everybody knew. So there were excuses that were made, and excuses that many people saw through regarding the systemic significance of large regional banks. There was zero doubt in anybody's mind that Credit Suisse was a globally systemic bank. Similarly, while we can look back and say, look, this was growing for quite some time with these regional banks, with Credit Suisse, the problem was as plain as it could be, not just to bank management and supervisors, but to the general public. They simply lacked a viable business plan because of endemic structural failures in their compliance and other departments that had been around for a long time, that hadn't been rectified, and everybody could see that they hadn't been rectified. So they were kind of limping along. Their capital was fine, but their core business model was not a long-term viable business model. And so you had this huge problem right in plain sight involving a GSIB. And yet, and again, I think the Swiss are actually more happy than they ought to be with the mode of resolution. Not only was there, the Swiss government had to come in a modest way, but at least still some way, but you ended up, of course, with the acquisition of Credit Suisse by UBS. And so you have an absolutely monstrous bank that if you are the Swiss government, I think you ought to be incredibly concerned about what you are actually going to do in terms of trying to promote its stability going forward. And again, I think when the only exit plan you have, other than massive government bailout or allowing it to fail in a way that inflicts real harm on the real economy and on real people, is to instead actually push it off for another day by allowing incredibly large banks to become even larger and pose a greater threat in the future, like you haven't succeeded for resolution planning. And so I do think I just want to make sure that we double down, because I think Shannon's right that they've made progress. They've tried to make progress for the past year. But whether that's adequate, I think a lot remains to be seen. And it's not just the problem in regional banks, but that we really haven't actually figured out how to create an orderly resolution of a large globally systemic institution, even when they are failing slowly and everybody knows that failure is likely to be imminent, even if timing is uncertain.
Yeah, I agree, Kate. So let's turn now to the path forward. What do we need to focus on? What are the most important things to address as we move forward in this environment that we're currently in? We've talked about a lot of things, and I think of it as, there's a long list of things, but they really form this interconnected shield, sort of this matrix of protection of things that we know are problems, and this matrix of protection can really can do a lot. So we've talked about strengthening regulatory capital and liquidity rules for the largest banks. We've talked about enhancing resolution planning, enhancing accountability and corporate governance rules, holding bank executives accountable, and many other things. So, Kate, what do you see as important steps, either things that I've mentioned or even other ideas that you have that we need to focus on going forward?
Perhaps this is too dire of a take, but I have to admit that I fear in the current moment, my goal is not to figure out what are the steps that we need to take to improve the situation, even though they're very important steps that we need to take and ought to take if what we care about is the long-term resilience of the financial system. I fear instead, much of the priority right now is going to be in damage control. And I think we see that in the United States, but unfortunately, I also think we see it globally. One of the many phenomenon that contributed to the degree of deregulation and also just the failure of regulation to evolve as the financial system evolved in the years leading up to the 2008 financial crisis was this global competition to create more accommodative regulatory environments. Even before the recent election in the United States, Brexit and the dynamics around Brexit seem to have started to create somewhat of a competition between Europe and the UK to be more attractive and more friendly to financial institutions. And the United States has certainly jumped on board and accelerated to the front of the race in that effort in the short period of time that we have seen since inauguration. And I agree with you, this is an ecosystem, right? So the weaker, if you have really strong regulations, then supervisors have to do a little less work. The more inadequate the regulatory regime, the more inadequate the structures in place to resolve institutions in an orderly fashion, the more pressure there is on supervision, and also the greater likelihood of government intervention. And what I really fear right now, actually, is not the status quo, but a weakening of the status quo, a further gutting of the capacity and authority of supervisors to ask hard questions, to go in and really bring about reforms when they see potential threats to the safety and soundness of institutions, and an overall weakening and allowing in of new risky activities in ways that really are not healthy for the banking sector as a whole.
Thanks, Kate. I have to agree with you. I mean, we're already hearing mentions of questioning the validity or the value that looking at non-financial risks, for example, operational risk or management risk, questions about what value does that bring in the supervisor's work. And it's I think we only need to look to these postmortem reports to see the examiners were spotting problems, but if their opinions and their conclusions are being questioned or pushed to the side because the financial numbers look good, then I think we're setting ourselves up for more problems in the future. Jeremy, what other observations do you have to add about?
Yeah, I mean, I agree with Kate, and it's interesting to be having this conversation in this moment, given that there are so many more pressing risks that seem to be imminent. But if the question is, what needs to be done to prevent another 2023 regional bank crisis, there's a very clear playbook. The Biden White House issued a fact sheet at the very end of March 2023 with a slate of common sense reforms in terms of, strengthening liquidity requirements, adding long-term debt requirements for large regional banks, preventing the opt-out of AOCI, which is how SVB was able to shield a lot of losses from having a hit on capital. I think some of the living will reforms you mentioned, Shana, were in that fact sheet. Outside of the living will reforms, the banking agencies have adopted none of what should have been pretty low-hanging fruit reforms to prevent the kind of failures that we saw in 2023. Contrast the banking agencies' intransigence on those Biden recommended reforms with how quickly the banking agencies implemented a lot of the Trump executive orders just within the past couple months on DEI, on staffing levels, on climate financial risk. The banking agencies were very responsive to the Trump orders, and yet basically ignored the playbook that President Biden laid out to fix the risks that gave rise to SVB and the other regional bank failures. So I think if we're trying to prevent another crisis that looks like 2023, all we have to do is dust off that playbook that President Biden laid out, and unfortunately has been shoved in a drawer somewhere.
But good to know that it exists. It still exists. So we're getting a lot of questions coming in through the chat. I think let's go around once more with just key takeaways from each of you, and then we can shift into the questions. So Jeremy, I'll let you go first. What's your key takeaway that the audience should go forward with? Yeah,
so to sum up, a lot of my comments have focused on the regulation of that $100 to $250 billion population. I think we need a DSIB framework. We have this idea that Kate mentioned of global systemically important banks, GSIBs. The Basel Committee, which recommends standards for jurisdictions around the globe, also has an approach for domestic systemically important banks. Many other jurisdictions have embraced that approach and give heightened oversight toward their, regional banks that could affect the local, the national economy, if not the global economy. Acting Comptroller Mike Hsu gave a speech last year, 2023, recommending a DSIB framework in the United States. He didn't really put a lot of meat on the bones in terms of what that might look like. But I think we need to better embrace the idea that we have firms here that may not be systemic on a global scale, but are certainly systemic on a national scale, and they ought to be regulated and supervised accordingly.
Great, thanks, Jeremy. Kate, what's your takeaway?
I guess two final comments. One, I think abstracting out a little bit and linking back to where Dennis started the conversation, I do think as we're facing these ebbs and flows, it's really important not to lose sight of the long-term aims and how broadly embraced those aims should be. There's a danger in the current moment of deregulation to think that the reason that we want deregulation is we want to promote economic vibrancy and a flourishing economy. And that is the narrative that right now some are trying to spin. And I want a vibrant economy. I want a strong economy. And I think the best way to get that is to make sure that we have a financial system that is able to provide credit and financial services through good times and bad. And there's a lot of empirical work that shows, and Dennis relayed this beautifully at the beginning, that real people and real businesses suffer during periods of systemic distress. And so what we're really trying to achieve here is to make sure that people continue to have jobs, to make sure that they are not underwater on their mortgages. And so some appreciation that what we're trying to do here is not to impose costs, but to create a more resilient and protective system that promotes the long-term economic health and the growth of the economy in a way that really is going to benefit all. And I think there's a little bit of effort to lose sight of that intentionally among some actors right now. Another point going forward that I can't help but mention, because it's been implied in a lot of our conversation, is the relative independence of financial regulators. We've seen an executive order come out from President Trump trying to put significant hamstrings on that independence, not only by requiring a WIRA review, which is effectively White House review of regulatory actions, but also through controls of personnel and budget and legal positions. And what that actually means and entails is in part contested because his view of the power of the executive is currently contested. But I think that does pose a real threat to the aim I was just talking about, which is really empowering regulators and empowering supervisors to think long-term about what's going to benefit the economy rather than having to accommodate short-term pressure from interest groups, to adopt stances that actually just enable risks to build up in ways that are threatening to the health of the system.
Thanks very much, Kate. I would add that, one of my takeaways touches on a point that Jeremy, that you made earlier, that I think we have an opportunity in front of us to consider all of the costs that are involved in a bank failure. We often only look at the cost to the deposit insurance fund, from a financial standpoint. But when failures like these happen, they don't just we don't just see that number as a financial number on a balance sheet somewhere. There's all these other costs and contagion that affect people's people's real lives and their trust in the banking system. And we need to keep in mind that having a strong banking system really does help all Americans, and keeping that in the forefront of our minds as we think about how best to deal with these problems. So with that, we have a ton of questions that have come in, probably far more than we're going to get to here, but two of the main focus areas on these questions is one, the financial regulators themselves and the different pressures that they're under, and then two, on interest rate risk that we talked about a little throughout the conversation, and different risks that we know were there. So let's first talk about the financial regulators. One of the questions on this topic that we got, I'll just read some of it here, that a major problem that often goes unnoticed is that financial regulators can't win. If they step in to prevent a problem, it's viewed as regulatory overreach. And if they don't, and the problem happens, then it becomes that the regulators are incompetent and didn't do their jobs. So any other thoughts that either of you can offer on this?
I'll jump in. I think this is Justin Chardon. Great question. I saw it come through. I absolutely sympathize with the quandary that regulators are in, and I think it's descriptively accurate in terms of some of the dynamics. I am slightly encouraged by some of the reactions that we've seen post-2023, primarily from the big banks. Right. So what happened after the invocation of the systemic risk exception was the FDIC had to levy assessments on surviving banks in order to replenish the DIF. Those assessments fell primarily on the largest banks. And you saw some pushback from the banks, the big banks, not liking that $20 billion or whatever the assessment was. So I'm somewhat optimistic that going forward, there may be less resistance to proactive action by the regulators, for example, to shut down a floundering bank before it fails and causes a crisis. I note in particular, there was a paper written by Randy Gwynn from Davis Polk, who's counsel to a lot of the GSIBs. That paper advocates for the FDIC to have much broader discretion to shut down a bank before it fails if it is showing indicia of distress. In as much as that view can be imputed to the GSIBs for whom Randy works, maybe we will see less resistance to proactive regulatory action or supervisory action to shut down faltering banks in the future. Still untested. We'll see what happens, and who knows what will happen if that regulatory or supervisory discretion is applied to one of the really big banks who, may in retrospect have preferred that SVB be shut down earlier. But what would happen if, U.S. regulators tried to shut down a GSIB? Might not get as much discretion, but it's a really complicated political economy dynamic. And Justin, thanks for pointing it out.
So let's move on to the questions about interest rate risk. This is something that we know was a problem with many of these banks that failed, and the fact that the current capital rules do not, or the current capital rules could certainly be improved to help protect against interest rate risk. Kate or Jeremy, anything to add about that topic?
I can jump in there quickly. I mean, two quick comments. One, Europe does do a better job of this. We know how to do a better job with this, and we easily could. That being said, I do, even though robust capital is the absolute cornerstone to healthy bank regulation, it's not the answer to every single type of risk. So I do think there's more we could and should do with respect to capital. But if you look at a lot of the banks that failed, and actually I think Corey mentioned this in one of the comments, it was true with Credit Suisse, but it was also true with Silvergate, SVB, and Signature. Like, they had business models that also really failed. And so I think there's also, going back to the complementarity of different types of tools, this is why supervision is so important. I mean, I have a real fear that the degree of discretion that is given supervisors has been too little. And yet, rather than figuring out how to empower supervisors, we are going to enter an era, we're going to try to disempower them and undermine the type of discretion that they have exercised for nearly a decade in ways that really have enhanced the health of the banking system. We certainly had banking problems, but we could have had far more than we do. And that's because there's going to be gamesmanship around rules, but also different business models do protect different types of risks, and supervision allows regulators to go in a more tailored way and say, look, like if you're exposed to crypto, maybe we're going to let you do that, but we're going to make sure that you have the appropriate guardrails associated with trying to take those actions. And we really are going to like hammer a lot closer on your resolution plans and what the spillover effects might be should something go wrong. So I do think that there's a lot more that we could and should do on interest rate risk. But I also think that this is all of the more reason that we absolutely need bank supervision and bank supervisors who are appropriately empowered to be part of the solution if the goal is to create a long-term resilient banking system.
Yeah, I would just add, I mean, I agree with Kate. I would add that the interest rate risk issue demonstrates the problems of solving for the last crisis. Right, 2008 was a credit risk crisis, and Dodd-Frank and Basel III focused primarily on solving for credit risk. We all seem to forget a little bit about interest rate risk as our attention was diverted. And I fully admit to trying to solve for the 2023 crisis here with my recommendations today. But I think that goes back to Kate's point. Like, regulation probably should try to solve for the last crisis. Supervision is what's forward-looking, and what we need dynamism in to be on the lookout for what are the emerging risks coming around the corners. So all by way of saying discretion absolutely necessary, and we need forward-looking supervision because the next crisis is not going to look like 2023. It's going to be something entirely different.
I'm so sorry, I have to just jump in on this. I'll let go in a second. But I mean, one of the things where we actually are seeing pushback by the bank trade groups for supervision is on operational risk, right? And they're like, look, they're going in, they're crushing on operational risk. And going to Jeremy's point, that hasn't been the problem for the last two periods. But if you think about cyber risk, if we look at what happened with Citi just over the past week with two different instances, operational risk is a huge problem. And it is one that, again, is very difficult to resolve entirely through capital regulation. And so it is really important, given the op risks that banks are exposed to, that they are subject to some level of scrutiny over making sure that they actually understand those risks and they have appropriate systems in place to try to deal with those risks, particularly when they're targeting potentially a target of things like geopolitical activity. I mean, it's an easy way to bring down a country or an economy is to bring down its major banks. So in some ways they could be a victim, but that's part of the reason if we want a healthy financial system, we want a healthy economy. These are precisely the areas that we need supervisors asking really hard questions. And so it has been troubling to me that I've heard a call for a sea change with respect to the capacity of supervisors to look at things like operational risk, which actually seem to me right now to be areas that are exactly where they should be asking hard questions.
Yeah, I couldn't agree more, Kate, that the calls for minimizing operational risk are really scary, and I think are a big mistake given what we know about the operational risks and things like. It seems like it's only getting worse with cybersecurity, with various IT risks, and certainly not something that we should be minimizing. It looks like we need to wrap up soon, and let's go with just one more question. I think that certainly brings us to the current moment and the discussions that we've had recently around cryptocurrency and debanking. Some questions here about the banks that failed that had ties to cryptocurrency. Any lessons that either of you think that we should take forward in that respect?
For my part, reliving and thinking about the 2023 crisis a lot over the past few days has definitely made me even more wary of some of the push on Capitol Hill to whatever you want to call it, debanking, fair access, reputational risk. There is a push to require banks to serve all comers and to reduce banks' discretion to deny services to certain classes of firms. Now, there may be something to that. I think that having those fair access conversations are worth having, but to force banks to provide services to, for example, crypto firms can be problematic for reasons that we saw in 2023. It goes back to the business model risk that Kate was referencing. So I worry, and I don't know how those debates will be resolved on Capitol Hill, but I think as we have the debanking conversation, we need to remember how heavily involved the regional banks were that failed in 2023 with crypto. And do we want all firms to have to get themselves into that position if their clients want those crypto services?
Yeah, I agree. Thanks very much. So we're a little over time, but I think and still have a lot of questions that we didn't get to. So apologies to any of the attendees that we didn't get to your question. But thank you to Kate and Jeremy and everyone else who helped put together this event. I think it was a great discussion, and thank you everyone for joining the webinar. We look forward to continuing this conversation as we all work to make our banking system work better for all Americans. So thank you again, and have a great afternoon, everyone.